What up, family? It's your favorite uncle, cousin, Tyrone Gregory, back at you again, as always, with another video. And today, I am going to cover the all-new deduction for businesses that was introduced to us in the new Tax Cuts and Job Act, the new tax bill that just took place. And I really kind of wanted to go through it a little bit in just a little bit more detail, because when I made the video, the 2018 tax update, which, by the way, does, so I say that information is still good up until 2025, just for those of you who are wondering. But in that video, I did mention this deduction, gave you a little bit of it, but now here in this video, I want to kind of go through just a little bit deeper, right? Because again, my goal as your favorite uncle cousin is to, one, make sure that you have the knowledge, two, to make sure that you have the resources. And the reason I want you to have those two is because it's important to me that you are aware and knowledgeable so that you can make, decisions that is going to be the best for you and your business. And I went online and searched this 20% deduction. I went out there and did my research, and it's funny that all of the information that's out there, it's like, accounting's teaching other accounting. So the language is like, what? Like, what did they say? Like, what does that mean? So I'm going to do my best. Here's my take on it so we can break it down, understand it, what it is, how it works, and everything like that. So let's go ahead and get to the video. Here it is, the new 199A deduction, the nuts and bolts of how these things work. So let's start with a discussion of the what. What is this thing exactly? Now, it's been called a number of things. Of course, it's the 199A deduction. It's the pass-through deduction. It's the business entity deduction. It's the business deduction. It's the 20% deduction. Well, regardless of what it is called, okay, what I want you to know is that it is going to give you a 20% deduction. That is what it is. The 199A, named after the section in the new law, section 199A of the new tax law, that's what it's named after, is going to give you 20% deduction. Okay. Now, one thing to note about this deduction is the fact that it is a below the line deduction. And that is something that we tax professionals use to describe any kind of credits or the deductions that come after your adjusted gross income has already been totaled. And let me give you an example. See, here is the new 1040, part 2 or page 2 of the new 1040. And you can see right there, line 9, where it says qualified business income deduction. That is where the 20% is going to go. But if you look at line 7, that is your adjusted gross income. So as you can see, it's below the line of the adjusted gross income. And the reason this is important to know is because there are a few credits that are based on your adjusted gross income. The earned income credit, one of the biggest credits that the federal government offers, is one of those credits that's based off your adjusted gross income. And there are a few other credits that also involve, or should I say that's calculated based on your adjusted gross income. So I want you to know this for planning purposes, because understand that if your AGI goes over a certain amount or it goes over a certain threshold, then whatever credit you're applying for, you may not receive because you have too high of an adjusted gross income. And because this 20% deduction is below the line, it will not have any impact on that. All right. So when it comes to planning, do not plan on reducing your AGI for purposes of credits by anything, because it is a below the line adjustment. All right. So this 20% is based on what we call QBI. Okay. And QBI stands for qualified business income. Now, the IRS have their own fancy definition of what qualified business income is. But like I said, you should hear accountants explaining it to accountants, CPAs explaining it to CPAs. It's amazing and I love it. But your uncle cousin definition is simple. QBI is your income, your total income, your gross income minus your total expenses. It's the same as your net income. All right, that's what QBI is. So in order to determine your qualified business income, take all of your gross income minus your expenses, and what's left over is your net. That is the starting point of the calculation. All right. So let me tell you what it isn't, because we know what it is. It's a 20% deduction based off qualified business income. But now let me tell you what it isn't. It is not a credit. And here's what I mean by that. Credits reduce your tax. This does not reduce your tax. However, it does reduce your taxable income. So in either case, there is a reduction. Now, you may be asking yourself, what's the difference? And of course, it all depends, because everybody's situation is unique. Everybody's situation is different. So some people may want credits to reduce their tax. Other people may want to reduce the overall taxable income. But in either case, there is a reduction. Now, let me show you what I mean by looking at this 1040 one more time. So again, we look at line 9. That's where the 20% is going to go. And then you see line 10 is taxable income. So line 10 is the amount that we actually pay tax on. And because it's above line 10, we are going to subtract that 20% out from everything else. Then we'll determine what our taxable income is, put that amount on line 10, and then we can see line 11. Based on the amount that's on line 10, we'll determine our tax, enter that on line 11. But if you look immediately under line 11 at line 12, that's where we figure all of our credits. And if we just follow the flow, once we figured our tax, we put that on line 11. We're then going to subtract, as line 13 would imply, subtract all of the credits, and then that's where we end up with our total tax. So understand that it is not a credit. It does not reduce tax. It reduces taxable income. But again, in either case, there is a reduction. Also note that it is not refundable. Okay. And in the tax world, refundable means that any amount over your total tax liability is refunded to you. That's what you physically receive in your pockets. That's what it's tangible. You can spend it. It's in your bank account. Any amount over your tax liability is coming to you. That's what the word refundable means. So because it is not refundable, I'm sorry, but that means that you are not going to see any money, or you are not going to see that 20%, whatever that amount is, in your pockets. Sorry. Moving on. So who is eligible? Now, this is where the fun begins, because we get to determine, well, who's actually eligible to take advantage of this 20% deduction. And if you guessed it, the fact that it's a business deduction, so therefore only businesses can take it, you are absolutely right in your thinking. However, C corporations do not qualify. I'm sorry, but if you are a C corp, you are not qualified to take this deduction. No profits from a C corp, no dividend distribution, no W-2 wages, no anything from a C corp does not qualify for this 20% deduction. On the other hand, if you are a sole proprietor, boom, you're good to go. If you are an LLC, and I mean any LLC, a multi-member LLC, single member LLC, LLP, which stands for Limited Liability Partnership. If you are an LLC of any kind, bam, you're good to go. If you are a partnership, boom, you're in. And if you are an S Corp, yes, I know we said C Corps are not allowed, but guess what? S Corps, bam, there you have it. You are good to go. So that pretty much covers the entire gambit. So I guess it's safe to say any business except C corporations. Sorry, guys. Also note, when it comes to the distributions or the income, wages from an S Corp and from a partnership, because this is particularly pertaining to S Corps and partnerships, wages and guaranteed payments are not counted in the calculation of that 20% deduction. Okay. So, and yes, I know you may be thinking, well, if I pay myself a wage, that technically is income from my business, so it should be qualified business income, but that's not the way the IRS has it. So wages and guaranteed payments do not add to that calculation. So we can't bump the number up by adding additional income in there. So definitely keep that in mind. No wages, no guaranteed payments. All right. So now we get to have some fun by determining how is it calculated? Like, how do you actually get this credit? And before we really get to how it's calculated, we need to know that there are thresholds. That there are thresholds that we need not cross. So I can say we need not cross. Hopefully you do cross the threshold and make all just bukus of money and the thresholds won't even matter. But for the most part, as long as you stay below these amounts, you are good to go. And they are $157,500, so $157,500. That threshold applies to every filing status except for married filing joint. Okay, so as long as your income is beneath this amount, and this is what I'm talking about, your taxable income, and we just looked on the 1040, I'm talking about your taxable income. As long as your taxable income is beneath this amount, the calculation is straightforward. And for those who are married filing joint, this is your threshold. If you notice, it's just $157,500 times 2 because there's 2 people on the joint return, so the threshold goes up. Now, let's look at this and see. So again, I just stated, as long as you are under those thresholds, $157,500 or $315,000 for those who are married filing joint. As long as you're under that, the calculation is simple. It's going to be 20% of your qualified business income or 20% of your taxable income over net capital gains, whichever is smaller. Okay. You know, the IRS is never just going to give you the bigger one. We got to do a comparison and you'll be able to take the smallest one. That's how it is. So again, as long as you fall under those thresholds, it's very simple. 20% of your qualified business income or 20% of your taxable income if that is smaller. All right. So let me give you an example. Let's say you had qualified business income of $50,000 and your taxable income was $80,000. Well, what we're going to do is determine 20% of both. We'll look at 20% of the qualified business income. So 20% of 50,000 gives us 10. Then we'll look at 20% of the 80,000, which gives us 16. So again, just a reminder, we are going to take the smaller of the two when doing the comparison. So in that case, the 20% is going to be the 10,000. The QBI wins in this case right here because it's the smaller of the two. Now let's look at another example and just kind of reverse it a little bit. Let's say you had QBI of 150,000 and your taxable income was 80,000. And before your brains get to going, like, how can you have business income in that amount and your total taxable income is less? Well, you might have itemized and wrote a bunch of things off and then ended up with taxable income. Trust me, it happened. So let's just assume that it happened with this taxpayer. The 20% of the QBI comes up to 30,000. Well, the 80,000 still remains the same at 16,000. So of course, again, we have to take the lower of the two, which in this case, the 16,000 is what we're going to be able to put on line 9 of the 1040 as our qualified business deduction. Okay. So what happens if you go over those thresholds? My note here, hire a professional. Okay. And the reason I say that is because things get real tricky, right? Things get real intricate. Things get real complicated at this point. But let's go ahead and walk through it. So remember, as we just reviewed, if you're under the threshold, the calculation is simple. 20% of QBI, or if smaller, 20% of your taxable income, right? Very simple. And here is where things get very, very interesting. So if you go over those thresholds, if you the first dollar, right? So 157,501 or $315,001. The minute that comes into play, this now comes into play. Because in order to determine 20% of your qualified business income, we now have to determine whether your business is an SSTB or a non-SSTB. And I know you're scratching your head like, what? Okay. Definitions are in order. So an SSTB is called, or should I say is short for specified service, trade, or business. Okay. Specifically, the IRS says that if the services provided is in one of these industries, and that's health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, investing and investment management, and any trade or business where the principal asset is the reputation or skill of one or more of its employees, it's an SSTB. Now that's a large blanket that has been cast. So a lot of people fall under this category. And I like to think of it as if your business is not like dealing with something tangible, like if you don't have inventory, if you're not, physically selling like a physical product, then it's highly probable that you will be considered an SSTB. And it's very important to keep that in mind. Okay. So, a non-SSTB is obviously everything else. All right. That's a very simple definition. So looking at that again, now that we know, once you go over those thresholds, in order to determine your 20%, it is going to be based off whether you are an SSTB or non-SSTB. So I'm going to start with some examples of a non-SSTB first. Okay, let's say that the income is in between the 157,500 and 207,500 because they give you like a $50,000 in between. That's called the upper threshold. It's $50,000, right? Or if you marry, filing joint, it's $100,000. But if your income is in between those two numbers, then there are 4 additional calculations. All right. That's why I say hire a professional. Get some help there. 4 additional calculations. Now, if your income exceeds, like if you go over the threshold, right? The 205,500 or the 415,000. If you go over that, then there are 9 additional calculations. Okay. So, and I wanted to say the non-STBs first because it's they are allowed to exceed the thresholds, and you'll see what I mean by that in a second. So, what happens if you are an SSTB? Okay, well, if taxable income is between the 157,500 and 207,500 and the same amount for married filing joint, then there are 12. Count them. 12 additional calculations. Yes, 12. Yes. And if your income exceeds the maximum threshold, if the income as an SSTB exceeds the maximum threshold, then you just don't get it. You phase out. Is what they call it. Like it just goes away. I mean, it just zeroes out. You won't get it. You won't qualify for it. Very, very simple there. All right. And so that's why I say things get very intricate. 12 calculations, 12 steps. Oh my goodness. I can see why the accounting community was up in the uproar trying to figure out how all this thing worked. I get it. But note, okay, at this point, wage and the wages you pay out and the equipment that you have or the equipment that you purchase as a business come into play. The minute that you go $1 over those thresholds, this comes into play. And because the reason why is a lot of the calculations compare the 20% of the qualified business income to what you paid out as wages and what you have as equipment. And this is important, especially for my S Corp holders who are not paying themselves a reasonable wage, right? If you don't have wages to compare, when they do the comparison, it's always going to be zero. So keep that in mind. If you don't have any wages, if you don't have any equipment that you purchase and that you're depreciating, when they compare it to and they take the smaller, well, if you have nothing to compare to, the smaller number is always going to be zero, which means that you are not going to get the 20% deduction. So wages and equipment come into play there. And again, even still, after we've done all of those calculations, we still have to then go back and compare it. Well, which is smaller, 20% of the QBI or 20% of the net taxable income? Alrighty, my good people, my family, that's it. That is a real quick visual, deeper dive into the calculation. I'm glad that you watched the video with me. Thank you for being here. As always, make sure that you hit the subscribe button, but don't just hit that subscribe button. Also make sure that you hit the bell icon so you'll be notified when I'm uploading new videos, as there will be a lot more discussions, a lot more things coming your way. So you want to make sure that you are verified there. And also, if you want to join the newsletter, feel free. Click on the link below. Go ahead, enter your information, join the newsletter where I share even more extremely valuable information. And if you need to reach me, leave a comment below. I do my best to respond to everybody. Find me on all of my social media platforms here, and here. And I do believe that is it. Yeah. So looking forward to hearing your thoughts on it. What have you found on this 20% deduction? Have you seen it yet? Have you played around with it? Yeah, just curious to know how things work with you. And until then, family, I love you. Appreciate you. And I will see you later.